treasury stock. This is what's part 2 for chapter 10. Now, treasury stock. Issued shares reacquired by the company by going out into the market and buying back your own stock. Now, why do we do this? Well, the company has issued all its authorized stock, or it needs stock for distribution to employees. The business wants to increase net assets by buying its stock low and hoping to sell it higher. Management wants to avoid a takeover. Management wants to increase its reported earnings per share because it reduces the denominator. We'll talk about that later. Now, another reason that you would go out in the open market and buy back your own shares is if you want to take the company private. Good example of this is Dell Computer did that. All right, remember, issuing stock grows assets and equity because, one, by issuing stock, you increase your cash and you increase equity by showing stock and additional paid-in capital because you're always going to issue it above the par value. Purchasing stock shrinks assets because you use cash and equity because it subtracted from equity. Now, accounting for treasury stock. Recorded at cost. Remember, you ignore par value when you're dealing with treasury stock. It is a contra equity account, which means it has a debit balance. It reduces stockholders' equity and assets. If sold above purchase price, paid-in capital from treasury stock transactions is credited. Remember, you never can have a gain or loss when buying or selling your own stock. Also, dividends are never paid on treasury stock. So whenever we talk about dividends next, remember it's always based on outstanding because we can't pay dividends to ourselves. So just think that through. Now, we have a company with 500,000 shares of $2 par common stock, and they issued 100,000 at $20 each. So we book the cash times 20, we take the common stock times 2, and the difference goes to APIC. Now suppose we repurchase 5,000 of our shares on the open market for $16 per share. The rule is treasury stock is always booked at cost. So we're going to take 5,000 times 16, and we're going to debit treasury stock and credit cash. Remember, we're buying stock, so it's going to decrease our cash. Suppose they then sold 1,000 shares of the treasury stock for $25 each. So cash would be 1,000 times 25. The rule is treasury stock is always taken out based on what you paid for it. So we paid 16, so we have to take 1,000 out at 16, and the difference is going to be additional paid-in capital treasury stock. Now, what does this look like for the stockholders' equity section? So if our retained earnings is $250,000 at the end of the year, we do our section by saying first we start with our common stock. We have 500,000 authorized, but only 96,000 shares issued and outstanding. Remember, outstanding is issued, which was 100,000 based on the previous page, but we have to minus 4,000 because what did we do? We went out in the open market, we bought 5,000, but then we went back and sold 1,000, so we got 4,000 left in treasury stock. We then have excess paid-in capital for common stock and treasury stock because we sold it for a higher price than what we purchased it for. That gives us our total paid-in capital. We have our retained earnings, and then we have to subtract out the balance in our treasury stock account, which is 64,000. So that's how you get your 4,000. It was your 5,000 minus the 1,000 that were reissued. And that gives us our total stockholders' equity section, which is shown as part of your homework. So I hope that helps. Now we'll move on to dividends.